Hello, everyone. We're going to have a couple minutes and just let everyone join, and then we'll be getting started. Okay, Molly, ready to go.
Great. Good morning. Welcome. Thanks everyone for being here. My name is Molly Fisher. I lead the enterprise team at Modern Treasury. The events of these past few weeks have reminded us all of the importance of resilience. In a short period of time, we saw how important it is to build banks resilient to interest rates, to rising interest rates, a financial system that's resilient to panic, and a payments platform that's resilient to disruption. We've received a lot of inquiries from companies asking us about this final point, and many of these companies work closely with us. They relied upon the bank to handle sensitive payment processes, such as collecting bills or running payroll or dispersing payouts. And losing access to the bank's services created significant issues for them. While we were happy to work with them to help their businesses get back up and running, it became abundantly clear that a multi-bank treasury is really no longer, and it's a key priority. We're very excited to be here today to walk you through some of the key pieces to building resilience in your businesses. And our discussion will highlight three important considerations in setting up a multi-bank strategy: finding and selecting the appropriate bank partners, onboarding and integrating into multiple banks, best practices for scaling multiple banks within your platform. So we'll save some time at the end for questions, and you can submit your questions in the Q&A box in the chat. But first, we're going to get started with introductions. So Sam, if you'd start.
Hi, everyone. I'm Sam Aarons. I'm the co-founder and CTO of Modern Treasury. That means I lead technology here, which includes engineering, IT, and security compliance. And I'll pass it over to Matt.
Hey everyone, I'm Matt. I'm co-founder and chief product officer. So I focus on our product roadmap. I spend a lot of time with people considering using Modern Treasury and a lot of our customers and bank partners as well. And I'll pass it to Nick.
Hey everybody, Nick Farrow. I lead the bank partnerships team at Modern Treasury. I have a team that manage all of our interactions with our banks, everything from product integrations to all the way through to our go-to-market activities, and we're here to help. So we know it's been a stressful couple of weeks, but thanks for joining.
Great. And maybe to start, Matt, it might be helpful to give an overview of Modern Treasury and what we do.
Definitely. So just as context for how we got here, we started Modern Treasury about 5 years ago. Sam, myself, and our third co-founder, Dimitri, we worked at a mortgage lender. So we were giving people loans to finance flipping properties and servicing those loans on the back end, selling them to investors. And in the process of building this mortgage platform, we saw the complexity of money movement programmatically at scale, building the infrastructure around reconciliation, ledgering, treasury management. And we were surprised to find that we had to build all this ourselves. And when we looked around at what were other innovative tech companies, companies that came of age, and also established companies and platforms that have been around for decades in industries, not just in real estate, but in healthcare or education or payroll, how were they moving money? We saw everybody replicating the same infrastructure in-house with their own engineering teams, and oftentimes not building the right linkages between finance, treasury, product, and engineering to enable the company to operate efficiently and roll out products quickly. So we started Modern Treasury. Really, our first product was around this idea of one API into any bank. That was where we started in 2018. And over time, we've evolved the platform into what we call today an operating system for money, where we help companies across all those sectors in the economy build out their products and platforms so that way they can offer great experiences to their customers while scaling their business, in operations and treasury management, pieces like that. And I think the events over the last few weeks really brought to light the importance of where we started the company around one API into any bank, because we helped a lot of our customers navigate this crisis well. And we'll talk about that in this webinar. And I think one example that really speaks to the way that our customers navigated this was, we saw in the news a lot of companies were thinking about how they would make payroll or how they would pay rent for their office when they didn't have access to their corporate funds. When we look at the companies that use Modern Treasury, those were the payroll companies themselves that were processing payroll for those companies, or the companies that were helping with rent payments for consumers, and then paying off debt obligations and things like that, where you can't be late, and they're mission critical. And so we saw the importance of having a platform like Modern Treasury there, and also the complexity in navigating these situations well. And so what we'll talk about today in the webinar really builds upon both what we've done over the last 5 years, and also even over the last few weeks, how we've seen these companies thinking and navigating situations. So I'll pass it back over to Molly.
Great, thanks, Matt. And Nick, why don't we start with you? So can you talk through some of the considerations as companies think about the right bank partners to support their needs?
Sure thing. I think, firstly, maybe I'd start by saying, Modern Treasury, we recognize that for many of our customers and prospective customers, it's been a very stressful couple of weeks. One thing I would say is, my team and the company here is here to help. So at any point, if you feel like reaching out, we're always here to help. But I think, maybe Molly, when you think about banking partners, it really sort of becomes a question of what does resiliency really mean in terms of companies who need to move money through a bank to operate their product or provide their service. And really, I think the events of the past couple of weeks brought into very sharp focus some real home truths. And that is, there were many companies over the last 2 weeks who were literally thinking about, am I actually going to lose all my money? And so I tend to think about resiliency from a banking perspective in many different layers. And, the very first layer you might say is, is our money, our company money, and the money that we hold on behalf of our customers, is it safe? Second thing is, am I able to provide my core product and services? I rely on a bank or a number of banks to provide, ACH or payment services. Can I actually rely on that? And then the third thing is, I have different product features, some which maybe not quite as critical, but they're important features. How do I think about building resiliency into that part of my banking partnerships or my banking relationship? So I think number one to think about is, when I'm thinking about a banking partner, is, I might need different banks or a number of different banks to be able to perform those functions. It's pretty rare that a single bank is going to be able to do everything for a company in that situation. So I think, number one, I would say, when you're thinking about a banking partner, how do I box out each of those risks, or each of those risks to my business and my ability to, function as a company? And I'd make sure that I have, very sound, or very, I'm very comfortable with the relationships that I have with my banks, to one, ensure that, our money is safe, and we're able to move money quickly if we need to. And then the second thing I would say is, making sure that, for example, Matt mentioned payroll companies, right? Making payroll is the most critical function. The money has to go out. So if I'm thinking about the service providers or the banking partners that I have, I want to make sure I've got at least a backup, maybe 2 backups, to ensure that I can load balance or shift payment services across banks in an emergency. And then the last thing is thinking about, the additional layers of product rails or product capabilities and support. So a good example might be, a number of companies offer real-time payments or push to card, or kind of more, FedNow hopefully soon. That they are great products and they please customers and they create a great experience. But in the event of an emergency or some big disruption or dislocation to the system, I know I can always go back to maybe an ACH. It's not ideal in the short run, but I know that I can go back to that. So I guess, I would think about banking partners in multiple layers. I would think about just being, careful about making sure that I don't over-index on too many banks. Remember, you have to manage all of these relationships. But I would think about, getting to know each of these banks and making sure that I've got a backup plan for each of those circumstances and scenarios.
Great. Thanks, Nick. Can you also provide some color on the process of onboarding onto a bank?
Yeah, I mean, I think there's a couple of different answers here. In normal times, And if you were thinking about how you would build relationships without the pressure of what's happened over the last few weeks, or maybe if you go back further into 2008, 2009, ideally what you want to do is think about building a partnership and a relationship with a bank, right? Moving money for third parties, which many of our customers do, or moving money as part of their product is and can be challenging for a bank to wrap their arms around. So ideally what you want to do is have that bank start to get comfortable and get to know about your business and really understand how you move money and how you think about risk and all of those other things. So ideally, you want to invest in that relationship and invest in that partnership. Now, granted, what we've seen recently is we don't have as much time. So I think it's really important right now to think about coming to a relationship with a new bank under some pressure to really have a good understanding and really be able to tell a really clear story around what type of risks you face in the business. Do you really understand what type of risk the business faces? Do you have the tools and the people necessary to be able to manage those risks? And then lastly, I think not just being able to tell that story, but show some evidence or show how you actually execute on those policies, those procedures, that kind of thing. And the point of this is really to help the bank get comfortable, to really understand how the business operates. Remember, oftentimes banking teams are advocating, or they're advocates within a bank. They're talking to other internal risk groups and other internal teams that may not know your business as well as they do. And so you really need to rely on them to advocate for you. So the more information, the more clarity and the more transparency you can give them, I think is really a good place to start.
I might add on there too. I've been spending time with a few of the banks that we work with this week, and the banks are largely inundated following the events over the last few weeks with new customer requests to open new programs, especially in certain cases like FBOs. And so to just drive home the point Nick was making there, having all the materials ready, your compliance program well documented, historical, let's say ACH return rates and things that help basically reduce the turns when you're working with a bank. So that way you can go through those processes faster and make their life easier. That helps quite a bit. So just doing the homework in advance can help you get set up with a bank faster, especially in this environment.
Yeah, I guess the last point, Molly, I'd make real quick is I think, by and large, bankers, they're human beings. They want good outcomes for their customers, but they do operate in a world that has constraints. There are risk and compliance concerns. There are credit and all sorts of other operating risks that they are trying to get comfortable with. And the more that you can help them get comfortable, the more that you can empower them to, I guess if you want to say fight for you inside the organization, I think generally the better the experience. And then I think it's also having an understanding of what they deal with on a day-to-day basis and some of those constraints, and partnering with them. How do you navigate that together? It shouldn't be a combative, negotiating type scenario where we're trying to hold back information and kind of push them into something they're not comfortable with. I think the idea is how do you help them get comfortable with the business and how you operate it?
Right. That gives us a good sense of who is an appropriate bank partner and how to get started. Sam, I'd love to turn to you and have you walk us through some of the technical considerations to integrate into a bank.
Yeah, there are a lot of technical considerations when you're integrating into a bank. What I always like to tell customers and prospects is that no two banks are alike. A lot of banks are very similar to each other. There's a lot of commonalities. There's a lot of functionality and features that rhyme with each other. But at its core, every bank has slightly different idiosyncratic, if you will, differences between them. And that extends to even basic things such as how do you connect to the bank in the first place? A lot of banks have what we call SFTP integrations, which is file-based, a little bit of an older technology, a little bit more stable. But sometimes you have banks coming with APIs, and then you have banks that have both APIs and SFTP. So right off the bat, from a technical perspective, you're dealing with a few different technologies that you may not be an expert in. You might have to combine those technologies together. And that's nothing to say of actual payloads. So when you're talking to the bank, what do you tell them? What do they tell you? Every bank has a slightly different spin on how they report transactions and balances. And in terms of sending payments, there are some standards that cover some payment rails, but there are some payment rails where there are no standards. So it's really a free-for-all. You have to sort of implement whatever the bank gives you and whatever the bank decides. So from a technical perspective, every bank is different. Every bank behaves differently. There are enough commonalities at a high level that you can have something to make that easier to integrate with, such as modern treasury. But at its core, every bank sort of runs their own technology stack. And so you're bound to see differences between all of them.
Great. So now let's transition to best practices for scaling multiple banks. Now that companies have integrated into a financial institution, Sam, can you elaborate? Can operate their payment businesses across multiple financial institutions?
Yeah, when you'll always need multiple banks. I mean, we're having this conversation here because I think we've been talking about banks under the specter of, a few bank failures that have happened recently. But I think even taking outside, that event of a bank failing over, there are lots of things that you need multiple banks for just to survive sort of operational burdens, because banks consistently have minor issues or they have delayed reporting. If you're really a customer, if you're really the type of company who wants to be able to scale across different banks, you need some type of software to be able to talk to multiple banks at the same time, to be able to fail over transparently, because there are always going to be hiccups in the road, bumps in the road. And that's a lot of what Modern Treasury provides, is sort of a way to standardize the ability to talk to multiple banks. Because if you need good uptime, or you need like solid reliability that's always going to work, even in the case of bank failure, or just a more run of the road, we're going to turn off our API for the day, you need something like Modern Treasury, because the resiliency thing comes up every day. This is not a once every 10-year event. If you need operational consistency, you sort of have to go multi-bank from the start.
Great. Matt, can you talk about some of the best practices around creating that platform resilience and talk through some features that you think are worth building?
There are a few things here worth highlighting. Over the weekend, right after SVB went into receivership, Modern Treasury, we stood up a status page where we were posting updates about what we were seeing at SVB around file reporting, if they were giving updates around payments, if they were initiating payments in the first place. And that was how we were able to monitor the situation, both for us and our customers and for anyone else that needed access to that information. And really what enabled us to stand that page up was all the telemetry that we built under the hood at Modern Treasury to keep track of how systems are working. So that way we can identify issues and proactively address them, either programmatically or through human intervention in some cases. So that way there aren't disruptions to payment operations. And, in this case, obviously there were factors that you see less often, but like Sam was mentioning, there are oftentimes transient errors, like you have an SFTP endpoint that goes down and you try to transmit a file and it doesn't get delivered. And so if you're building a system that has to initiate payments every day for payroll or for contractor payments or whatever it might be, you need to know that the files you're delivering or the API calls to the bank are actually getting delivered. And then there's telemetry as well around what happens after that. So I've sent a Nacha file to the bank, or I've done a request for an ACH payment via API, or I've sent a wire. There's a lot that happens after around the payment networks that a lot of banks provide this information to you that can help you basically get the FedEx tracker for your payments. So you understand if things are rolling the way that you expect them to. So for example, for an ACH payment, did you get the trace ID, which is a network identifier that you can use to understand the progression of the payment through the network? If you don't get that, then there might be issues there. And part of it too is not binary. It's not just did I get it, but it's did I get it by when I expected to get it, which is another thing, because oftentimes these things matter. If you got the trace ID, but you got it at 2 a.m. instead of 2 p.m. the day before, that might actually mean that you missed the ACH cutoff window, but you might not realize it until you get an angry call from a customer the day that they missed their paycheck. And you see that later. And so part of what we've invested in a Modern Treasury is all the telemetry, observability, these systems that help us proactively identify issues. So that way, when errors happen and payments at the end of the day are messy and errors happen, we're able to proactively fix them. So, if there's the case where a bank system went down for an hour, Can we send the payment before the cutoff time so that we can get it through? Can we call the hotline we have at the bank to make sure that perhaps there still is the possibility of getting the notcha file in before that cutoff window? And I think that that's part of the customer support that we're able to do through our platform and through the way that we work with companies. And then if you work directly with banks, you have to do this. And then, in this world, if you're thinking about being multi-bank, the question is, how do you scale that operation across all your banks and have that on, in essentially an always on world? And perhaps ACH payments are asynchronous and don't happen every day at every hour of the day. But where we're moving is towards this world where FedNow is coming out this summer. We're going to see banks start rolling that out over time gradually. And so I think one of the things that's top of mind for us is, how do you have a robust, resilient payment operation system that's 24/7, 365? What happens if your payments fail at 3 a.m. on Sunday? Do they get retried? Do you know about it quickly? Are you able to communicate that with your customer? Those aren't trivial tasks. And I think when we think about a lot of legacy payments infrastructure, especially, those aren't things that they've built into it. A lot of technologies have been built for this asynchronous file-based world that we mostly live in today for payments. But as we move towards APIs and real-time payment schemes, that's going to change. So that's a big area that we think about. I think there are other interesting factors, like limiting blast radius is another consideration. So when you transmit files or payment instructions to the bank, sometimes you'll see failures related to a specific payment in a batch of payments. And you want to make sure that an individual payment that's failing doesn't blow up all the payments, or that you have mechanisms to pull out the bads so that we can still get the good through. And so, and again, to what Sam was talking about before, although bank systems rhyme, they do work differently at the end of the day across all of them. Your ability to do things like retry or communicate through other channels is also different. So we think about that a lot. And then the final area that I'll mention is just that when we think about money movement and all of the business considerations around it, it's not just moving the money. It's not just sending a notcha file or doing an API call. It's also all the financial reconciliation and treasury management that a company has to think about. So how do you close your books and understand the state of your cash across the business at any point in time for all the money moving, especially as we move towards a real-time world? That's not trivial. That's something when we talk to our customers, still, they spend a lot of time, whether it's engineering work going towards building reconciliation systems prior to using what we have at Modern Treasury. We see that often. We see companies that have a lot of full-time employees who are just focused on reconciliation and managing cash positions and things like that, rather than work that's strategic for the company to focus on. And so part of where we're focused is on building out the operating system that can work across different banks and different payment rails, can work if you have two FBOs managing the same program and you have to think about, what are my customer balances across both FBOs? Do I understand that at any point in time? Do I have the means to do an ACH pull into one FBO instead of another if my first FBO is having issues? And then can I track that balance in a consolidated ledger for that user? There are things like that that actually are pretty hard to build from an engineering sense if you go it on your own. And for better or worse, we have the battle scars from seeing that with a lot of our customers. And so that's where we spend a lot of time thinking with them.
Great. Thanks, Matt. So now we'll move to some Q&A. So just as a reminder, you can put your Q&A into the box at the bottom, the chat box. And we are going to start with what are your current recommendations and thinkings around latest best practices, balancing efficiency versus risk? And I'll put it to the group to answer.
I can kick us off. I think I had a phone call with the CEO of one of our customers on the Saturday when SVB went into receivership. And one of the things that we talked about was historically in this, thinking about product roadmap and efficiency and managing risk, we've seen a lot of companies opt towards a single bank path where, they have product to build and other things to focus on. And the risk of this doesn't seem that substantial. But I think in hindsight, we've seen a lot of the companies that were impacted by this really regret that decision to not invest in that early on. And so I think, like anything, it's probably an 80-20. There are certain efforts you can do that can reduce a lot of the risk. And so I would say that if I'm a company where payments are critical to the way that my business works, I would try to have a second bank or a second way to process payments just set up out of the gate. I think there are factors you can consider for how urgently you need to move, understanding what is your current bank partner or payment provider or banking as a service solution. How robust do you think they are? How well do you think that they could weather a potential black swan event if something else happened? I don't think any of us can predict the future perfectly, but there's that element of risk calculus. But at the end of the day, for a lot of these companies, especially the ones we serve, not being able to operate in terms of payments is existential. And so calculating the ROI on that can be difficult, but I know, speaking about our own company, we try to do things to avoid existential risk. And this for payments companies is unfortunately existential.
I might just add, I think also think about bank relationships. You have to manage them and cultivate them and spend time with them. I think it's important to remember that the relationship has to be something more than transactional for the bank as well. I talked before about how, a banking team is human and they're going to have to advocate for you in a time of difficulty. They will naturally prioritize customers who they have strong relationships with and have a strong understanding of their business. It can be difficult for them if you have a very transactional, one-off, low-level relationship for them to try to prioritize. So I think maybe just keep in mind that you do have to build those relationships and maintain them and keep them strong so that they're useful when you need them. And maybe having 6, 7, 8, 10 banks is really not that practical if you're a relatively early stage or a growth stage company. Might be worthwhile if you're a Apple or Google or somebody like that, but just remember you do have to manage those relationships.
Yeah, absolutely. This next question's for Sam. What if I bank with the GSIB? Do I need redundancy?
Yeah, that's a really great question. And this sort of dovetails a little bit in with the question that was just previously asked. We're invoking GSIB, so we're not going to be too worried about a bank failure. I'm not going to say never, but obviously the risk of that goes down dramatically. But that's not really the risk that you should be worried about day to day. And I tried to kind of allude to this earlier in the presentation. The real risk is that there is a seemingly minor hiccup, or there's something that goes wrong that impacts 1 day, 2 days, 3 days of payments. And those do happen, even at the GSIB banks, even at small banks. All banks run into operational issues. And so if we're talking about redundancy here, like Nick said, I don't think 8 is the right number of banks to have redundant relationships with, but 2 is probably a good number, because even at the GSIBs, you're still going to have operational hiccups, road bumps that I alluded to earlier that come up. But also there's just an ongoing maintenance that you have to always be on top of, no matter what bank you integrate with. Even if you choose a GSIB or a small bank, these systems change and they need maintenance, and you have to stay on top of changes to these systems. And there's a lot of effort that you have to devote to kind of keeping on top of these things. And those changes that happen to those systems, eventually they are going to come around and cause an operational problem. And so that happens at GSIBs, happens at all banks. I would say get 2 banks. If they're both GSIBs, that'll be great. You don't have to worry as much about bank failure. It's really about reducing bank operational risk on a day-to-day basis. I think that is the goal here. And that happens frequently, much more frequently than I think people realize.
Great. Thanks, Sam. Next question is, I get what Mercury, Treasury Prime, and others are doing to handle the pressures of the last few weeks. What does modern Treasury do to help me avoid the issues we all faced 2 weeks ago?
I can take this one. And I think we have 3 different types of companies here, and I'll speak mostly to where we focus. So we have Mercury, a neobank, and we have Treasury Prime, a banking as a service platform. And really our focus has been around providing a software platform that helps companies manage all money movement. And the approach that we've taken is we work really closely with our network of bank partners. We work really closely with the companies to make sure that the companies can manage their payment operations efficiently. And I think the key part there is that all of our customers have direct relationships with these different bank partners. And so we help make sure that they're always in touch with those banks. They're getting access to the latest and greatest in terms of technology, but also at the appropriate pace. So that way, they're not using systems that may not work as well. And the result of this, we saw even over the last few weeks. So we saw some companies that had Modern Treasury connected to multiple banks where they were able to, over the weekend, their engineers could do a one-line code change where their originating bank account for payments in Modern Treasury, they're able to flip it over to another bank. So that way on Monday, all payment instructions went through a different bank instead. And from the perspective of how their system worked, they didn't have to change anything. The webhooks came in the same way, which means that the way that their system responded to events, like did my payment come in? Did the other person receive the payment? Did I get an ACH return? That all flowed through in the proper way without really much work, simple one-line code change. So that's one major facet. And then the other one, and perhaps Nick can speak to this more, is we've invested really heavily in helping our customers navigate how to think about finding another bank partner with a lot of these large banks, as well as other banks that focus on particular, customer demographics, types of companies. And so just helping companies get through that process, I think, is really important, especially when this isn't the core competency of the business, navigating banks.
Yeah, I would just say on a very tactical level, the last 2 weeks have been a busy one for our team. We've spent really our nights and days trying to help our customers find new homes. Many of them are scrambling to find a new banking partner. The team obviously keeps really strong relationships across products and business lines and various other parts of the bank. So, as I mentioned in the opening, if you are struggling with that, we're certainly here to help, and you can reach out to us directly to do that. But I think, as Matt said, the important thing, as I keep stressing, is relationships. And this banking is still very much a people-driven business, and the ability to call in and get an answer from the team that you need is really critical, whether that's directly, yourself calling into a bank and getting an answer promptly, or getting the support you need, or perhaps relying on partners like ourselves. We're more than happy to do that. But yeah, it's been a stressful couple of weeks for everybody.
Great, thanks. A question for probably Matt and Sam, both of you guys. With the multi-bank strategy and the transactional nature of banks, any advice to offer on how to manage a primary failover configuration? Would you advise splitting volume to keep failover bank engaged?
I would be curious. I'm curious what Matt would think about this, because we might have slightly differing opinions here. It depends on your relationship. I think Nick brought this up really well. It depends on the relationship that you have with your bank. Is it possible to have two equally great relationships where banks are competing for your business and really want it? That's possible. And that does obviously happen. Most companies have the bandwidth to manage more of like a single, maybe a primary and a secondary bank relationship. Primary is where you have a lot of your banking. Secondary is where you have some of your banking. I'm not sure I'm such a proponent of you have to have 50% of the cash here and 50% here, and you have to run dual out of each bank account. I don't think that's necessarily going to be the best strategy, but I do think it's more of an 80-20. I do think maybe 80% of your volume, or have all your primary business go out of a single bank, single relationship, run that for a while, learn everything you can about that. And then you have 20% somewhere else, because in the event of an operational burden, you do want to be able to switch over rather quickly. You want to have some money there already, and then you need to have tested it before in the past. So if you maybe bifurcate, 20% of the flow somewhere else to a different bank, I think that's a good strategy rather than trying to run two banks simultaneously equally. But it depends. Every business is slightly different, but I think what we've seen, that 80-20 rule tends to hold up more often than not. But Matt, I'll pass it over to you.
Yeah, I can add on a few things. I largely agree. It's situationally dependent. It depends on what you're doing in your business and what's the complexity. So if you're simply processing ACH payouts, for example, that's pretty easy to run through, let's say, multiple banks or payment providers simultaneously. There's not that much complexity there. A lot of people can do that. I don't know that you actually get that much benefit to processing those payments through multiple banks, but you could do that pretty easily. So I think at the end of the day, it's more of a risk question. But then let's say you have a more complex setup where you have an FBO account with virtual bank accounts where you're subledgering user balances, or maybe you're actually programmatically creating bank accounts for your users. the more complexity that you see around your payment stack, I would recommend pushing more of that through one bank, just because the more, the more that's happening, the harder it'll be to manage across multiple banks. We try to make that easier, obviously, through what we do. But if you think about having an operations team, for example, that's serving customer requests, and if you have two banks that have different cutoff times, you might have one bank that submits payments at 6 p.m. Eastern and another one that does it at 6 p.m. Pacific, so a 3-hour difference. And you have a customer call in and they say, what happened to my payment, or am I going to get the money? And you have customer support go in and try to look it up. You're putting the mental burden on them to know, okay, well, how did these two banks differ in terms of how they process payments in this case? Like, when do they transmit them? And so I'm not sure if that is necessarily worth it from a day-to-day operational perspective. What I would say is you want to make sure that whatever backup or backups you have, that they work. And so that, I think, means you have it in the reserve, that you've tested it, that you've run payments through it, that you have any flows that you want to run pre-approved, that you've run some fake payments through, whatever it might be. So that way, you know that it is actually good to go when you need it. So, and that's especially true in these complex cases if we're thinking about virtual bank accounts and pieces like that. There are cost considerations there, and I think some of this is a risk reward trade-off depending on the stage of your business. So you might find that having an FBO at a bank has a substantial cost attached to it. And so in that case, perhaps having that second FBO, maybe that costs more than what's worth spending from your seed round. And so from that perspective, I'd go back to what Nick was mentioning earlier, which is you want to start building that relationship with the bank before you need it. So perhaps it means putting some of your corporate deposits there, helping them understand your business, catching up with them on a frequent basis, making sure that the moment you go talk to them, it's not just, hey, I need you right now. It's they know you and they have a relationship with you. So that's how I would think about it. We can definitely talk with anyone more specifically about that. And I think this is also a place where it's not just a conversation between us and the company. It's also a conversation with the banks and how they think about the setup and what you're trying to do with them.
I'm not sure if Molly was able to rejoin, but we did have another question. I might pose this one to both you and Matt, Sam. The question is, how do you see FedNow evolving the banking ecosystem in the US? And do we think that might be a real benefit to the system overall?
Yeah, I can take that. I think FedNow is going to be huge. I really think that FedNow is going to be a what I've been calling a sea change for payments in the US. And the reason why is because the coverage is going to be pretty high from very early on. I sometimes talk about this internally for people who are joining the company who are brand new, but in the United States, we tend to have two systems, or a public option and a private option for every payment system that we have. So in the ACH world, we have Fed ACH, public option, and EPN, run by the clearinghouse, private option. For wires, we have FedWire, public, chips, private. And for this concept of 24/7 instant payments, we have RTP, which is a private system that launched a few years ago. And now we have the public option, FedNow. And what history has shown us, at least in the United States, is that the public option gets fairly wide distribution because it's being backed by the Federal Reserve. And so that's what we're really looking for and hoping for, is that when FedNow comes out, a lot of banks will support it from day one. We're looking at a launch potentially this summer, which is very exciting. And when that launches, it's going to be very simple for a lot of payments to go 24/7, 365, which is a huge change over what we have today, that payments that either clear overnight, like ACH or wires, which take a few, which maybe take 15 minutes to an hour throughout the day, but then doesn't work on the weekends, doesn't work at nights. Other countries, to see how the change can be applied here, we just have to look at other countries. We can look at the UK with a faster payment system. We look at China with wallet systems. We can look at Singapore and Australia, who also have these real-time instant payment systems. There are massive changes that come about when those get widespread distribution, because now consumers can pay each other very quickly. Businesses can pay people very easily. It just quickens up a lot of commerce within the countries where we see real-time payments going wide. And we're going to see that here. And I think we're also going to see that knock on to other payment systems where we might see ACH volume go down a little bit, or we might see wire volume go down a little bit, not to zero. Every payment system still has its verticals where it's still very clearly going to take over, but we're going to see a rise in FedNow, and it's going to change a lot of payments, and it's really going to change consumer expectation, because once it becomes widespread, consumers are going to be asking, why am I waiting for a check in the mail? Or why am I waiting overnight for my money to clear? Or why am I going to send this as a wire when I can send it for free as a FedNow or RTP payment? You're going to get those questions every single day, and that consumer behavior change is going to precipitate other changes as well.
The other thing I'll add to that we're really excited about is a part of the real-time payment rails is this idea of a request for payment. So when we think about ACH right now, you can push a payment to somebody and you can pull a payment from somebody. And for anybody operating a business where they do ACH pulls, ACH debits, they know there's a lot of risk attached to that, both for business pulls and also for consumer ones when you have up to 60 days to return those payments. And as a business, you have to navigate that. That introduces quite a bit of fraud risk. And in the real-time payment schemes that are being rolled out, there's what they call a request for pay standard, which is for anyone that's used Venmo, it operates like that. You can send as a person or as a company originating payments, you can send a request to somebody else that they send you funds. And so it's a request that they push you money. And what's really exciting about that is because they're accepting the request and sending you funds, it means that that return risk is mitigated severely. There might still be some cases around consumer protection that allow somebody to get their money back. We've seen with standards like Zelle, there is phishing and fraud there. But we think the risk will be severely mitigated versus what we see with ACH debits today. It's also going to enable other things like more remittance information. So the request for pay standard supports including additional information electronically that gets sent via the payment networks. So that way it's easier for somebody to understand what they're paying, like their telecom bill or their recurring purchase or rent or whatever it might be. And we're already seeing this rolled out today. So the real-time payment standard has request for pay. Modern Treasury supports that. It's not fully available, so only certain companies are able to use it for certain use cases. Like we're seeing it used for investment platforms where people are funding accounts for purchases of securities and equities that cost a lot or that they're trying to spend a lot of money on. And I think that's one early example of this, but we're excited to see that become more generally available. There's still questions around how this is going to function exactly from a consumer perspective. So the way we're seeing it right now is the consumer getting a request for pay will get a notification in their banking app in their bill pay section, and it'll show that there's a request for them to send funds. I think that's a good early start for this. I think there's still a lot that needs to happen for this to become more generally available for consumers. But I think, like Sam was saying, if you look at the wave of how these technologies have been adopted in other countries, our perspective is that this will get adopted very quickly once it's generally available. And so, it speaks to having the systems that you need so that we can keep up with it and also not create a lot of tension in the back office once you're moving money this way.
Actually, maybe one quick follow-up for you, Sam. In the early days of the real-time payment network, we saw maybe some spotty coverage or some spotty service disruptions. How have you seen companies navigate that, backups resilient from a resiliency perspective if you maybe feel uncomfortable with the reliability of the network in its early days?
In terms of falling back to a different payment network? As I think, even operational issues aside with spottiness of the network, which I think is good, it's what you mentioned first, Nick, which is that coverage aspect. So RTP right now and FedNow very soon, it's not going to have 100% universal coverage in the United States the way that we sort of have that luxury with ACH and Wire today. RTP is in, I believe, 60% of checking accounts because it is available at a lot of large banks. You always need that redundancy. And so it becomes a very interesting technical problem when you try to send an RTP payment to someone, because there's a very real chance, 40%, that they don't have RTP or they can't receive an RTP payment. And so you've built all this infrastructure to send an RTP payment. Now suddenly you have to say, oh, but in 40% of cases, I have to send them an ACH or a wire as a fallback. And so we saw this use case enough that we built it into our software and we made it very easy to switch over. But that's a very real consideration. And that's just a single bank. You could be sending RTP and ACH at the same bank, but you still have to build your own failover logic to switch over when it doesn't support one over the other. And we're going to see that for a while. We're going to see that with RTP. We're going to see that with FedNow. That's not going to change in the immediate future, but that is some technical consideration that you have to think about when building these things, is that it's not 100%. So you need some kind of fallback. And so that's going to take some work and effort.
I just saw a question come in too from one of our customers actually said they, and the question was about there are ACH trace IDs and these tracking mechanisms for ACH payment schemes. Will there be something similar for real-time payment schemes like FedNow? And then what about in other countries and other payment rails? I think there are a few things here. I'll answer this briefly and then pass it to Sam, but we're seeing across these, there are quite a few what people call, or banks call, end-to-end IDs or similar mechanisms. And actually at the places we're doing real-time payments today, we're able to surface that information through our API and through our system. So that speaks to that information being available. But Sam, perhaps you can elaborate.
Yeah, so with the FedNow system, I'm not sure about the particulars. I would have to do a little bit more research. For the RTP system today, the equivalent of an ACH trace number is called an RTP instruction ID. And that's a unique identifier that gets stamped by the networks. That's a kind of a globally unique ID for that RTP payment. And all the banks that Modern Treasury integrates with to do those RTP payments, we get back that RTP instruction ID from the bank. So that serves as the identifier. FedNow, I think, is going to have the similar thing, just based on the work that was done for their ISO 20022 specs and their recon work that I was on the working group for. We're going to see those same identifiers come up in FedNow. It might be called something different, but as Matt said, every payment system is going towards this world of having these globally unique identifiers. As a side note, Swift wires have this globally unique identifier called a UETR, unique end-to-end reference. That is becoming the standard for wires globally. That's rolling out over time. Every payment system is sort of taking a cue from that and saying, okay, I need a unique, globally unique instruction ID on my payment system as well. So we're going to see a convergence in the future. But yes, RTP and FedNow, to my knowledge, are going to have those, and RTP definitely has those today.
Great. And there's a follow-on question on fraud. How will the quickening of transactions impact fraud controls in your estimation?
Yeah, that's a really great question. It really comes, the speed thing is important. I'm not going to deny that. Like, the speed thing makes it such that, and this isn't a critical distinction between batch-based payments or, like ACH or wire potentially, they have to happen instantly. If you're going to do some kind of check on fraud, or so going to have some kind of control, operational control internally that is maybe fraud adjacent, it needs to happen in real time. That consumer expectation is already there, trained by the fact that RTP payments happen within 10 seconds essentially. So if you're doing some kind of check, you can't wait overnight. You can't wait a couple hours. It has to happen right away. And so you need compliance systems that work instantly and work on the payments right away, because that's something that the consumers expect. The consumers aren't selecting an RTP or a FedNow payment because they want to wait an hour for their money. They want their money right away. And so you have to do those fraud and compliance checks right away. And it's not out of the ordinary. If we look at credit cards as an analog, clearly those are doing real-time fraud checks as well whenever there's a credit card swipe or a credit card authorization. So it's just a matter of reorienting the systems to not be batch-based, your fraud control systems, and to make them more real-time. And Modern Treasury has done a ton of work in that direction. But generally, that's the aim, is that you have to make instant decisions about things. And it necessarily means that humans are not in the loop. You do have to write automated systems here. You have to have algorithms that you trust. Humans can't be in the loop. A human can't approve and look at an RTP payment within 10 seconds. So that is an industry change as well that is coming with FedNow and RTP payments becoming more widespread.
Yeah, and I would make sure to think about how you're using payment methods in tandem with one another. So for example, if I'm pulling funds in via ACH, so doing ACH debits, and then remitting funds via a real-time payment, that might be a riskier way to do things, because on the front end side, people have more opportunity to reverse the payment potentially for up to 60 days. And then they can get their money out really quickly once you pay it out to them. And so this gets back to, how are you thinking about fraud holistically? I think it's going to become even more important to leverage some of the elements of fraud detection that are newer. So not just simple rules-based detection, but also their advances around areas like device intelligence, for example, user behavior when they're logging in, bank consortium data that can help detect fraud. These are all things that we've integrated into the Modern Treasury platform as well. So when somebody's processing payments through Modern Treasury through their bank, we're able to pre-screen payments and flag those in real time to our customers and provide programmatic notifications to their systems. That way they can tell somebody, hey, we're stalling on the payment perhaps, but it's really important to have those systems in place in a real-time payments world.
Great. Thanks. I think one more question that came in is around, are we integrated with any payment gateways or banks only? So Matt or Sam, I'll let you guys take that.
So there are a few parts of our platform as well. And you can think of it in engineering terms, there's a read part and there's a write part. So the write part is payment origination and sending payments or collecting payments and pieces like that. And from that perspective, Modern Treasury does connect to not only banks, but also other non-bank payment providers. We have a list of some on our integrations page. We have some that we haven't put out publicly yet and some that are on our roadmap. And the reason for that is we see companies that at the end of the day, oftentimes have different ways that they're trying to offer payments to their customers or collect payments. And then we're working on adding in other payment methods all the time. And so, things like card acquiring, card issuing, pieces like that. The other part, the read part, so to speak, is around reconciliation and how, as a company, do you reconcile all the financial activity in your business so that way you understand your cash position at any point, you can close your books. And even when somebody is processing all their payments through their bank, potentially through Modern Treasury, they oftentimes have other systems that they're using for card acquiring, let's say, but they have the same reconciliation needs there and the needs to consolidate that into one ledger. We even see that the number we talked about different types of companies earlier. We see companies come to us with a banking as a service provider, with a card issuer, with a bank, and they're looking for one consolidated ledger to make the home for all their data for reconciliation. And so that's a very common use case where we help as well. And so really that's about having agnostic ways to import data, consolidate it, and put it into a ledger and enable reconciliation for finance teams.
Yeah, and just to add to that maybe a little bit, yeah, on the right side, what Matt was talking about initiating payments, it doesn't have to be a financial institution. You can go on moderntreasury.com and you can take a look at those integrations. But no, we work with a lot of companies that are, you can think of as aggregators or intermediaries or wallets. Doesn't necessarily have to be a financial institution. One that I'll call out kind of explicitly is we work with a check printing provider called Lob. And so Lob can actually originate checks on bank accounts connected to Modern Treasury. And so we use that to augment or add check printing services to banks that either don't offer it or their pricing isn't competitive with Lob's. And we integrate those and others transparently into the Modern Treasury system. To Matt's point, it is a single pane of glass for accessing all of those payment methods, but it's also a single pane of glass for getting in information, the read side, and creating a centralized place where you can reconcile all that activity that you do between gateways, aggregators, and banks into a single place and reconcile that against the cash in your bank account. So there's a lot of examples of that. We could talk endlessly about that, but just wanted to call out a specific example.
Great. Do we have any more time for questions? I think we're probably almost at time here. I don't see any more questions coming in at this point, but we do want to thank all of you for attending, and definitely reach out to us at the banks@moderntreasury.com email if you want to discuss, if we have any specific questions or anything that we can help with. We'll also be sending out the recording of this and of the webinar as well. So thanks all for being here, and thank you to our panelists also for answering all the questions. Thank you.
Thank you.
Have a great day.
Thank
Thanks,
you.
everybody.